Good morning to all our attendees joining us today for our latest installment of our RSM webinar series. The topic under discussion today is our new Trust IT3T third-party reporting, something very new and topical. For those of you that have not met me before, my name is Neil Hughes. I'm one of the tax and trust directors at RSM South Africa, and I'm based up in the Joburg office. So to start off events, I think it'll be nice just to take a broad look at an understanding of what do we intend to achieve out of this webinar today. So obviously it is to get a great awareness of this topical issue, but we're going to break it down into a few small components and understand how it is that we've got to this position of this new reporting being required. We'll take a bit of a look at what the third-party reporting encompasses and the actual return that trusts will be required to file to SARS. We'll break down into a little bit of depth of detail what underlying fields actually have to be completed when this data is submitted to SARS. We'll cover on how you actually go about the submission process, what channels are available to make this filing. We'll also touch on the deadlines that are involved and how that fits into the bigger picture of trust filing deadlines at large. And I think the final section that we'll touch on is quite an important one, and that is the preparation that's required to be ready for this new IT3T third-party reporting process. So to kick things off, let's understand how is it that we've got here. Now, people that are taking a close awareness of trust and trust structures, they should be aware of the fact that SARS has focused a bright spotlight on trusts over the past number of years. And there is possibly a number of reasons for this distinct focus being given towards trust structures. One of the core elements is the poor levels of compliance by trusts in not just submitting their returns, but in attending to their general administration and compliance obligations. More so, SARS has conducted research where it has compared the volume of trusts that are registered with the Master of the High Court and comparing that to the number of trusts that are actually registered with taxpayers on SARS systems. And there's a distinct breakdown whereby many trusts and trustees are not fulfilling their obligations to go and register their trust as a taxpayer after it has been established. And this creates the distinct risk to SARS that these trusts are clearly not reporting their obligations. Another risk factor that has brought a spotlight on trusts is that the individual beneficiaries who may happen to receive awards from a trust aren't necessarily disclosing and declaring those details in their personal tax returns. So this has been part of the reasons why SARS has got this added focus on taking a closer look at trusts, being cautious as to whether they are being used as an inappropriate mechanism whereby people are evading or avoiding their obligations to disclose taxable income. So what has SARS done? SARS has embarked on a distinct and very purposeful journey to modernize and improve its service offerings to trust taxpayers. Now, part of this modernization journey has been to focus on enhancing the registration function. I have mentioned before that one of the distinct concerns is the lack of compliance by trusts in attending to the registration as a taxpayer. So they've tried to enhance this functionality whereby you can now attempt to register your trust as a taxpayer, not only by walking into your SARS branch, but by making use of SARS's online services on their homepage. So they're trying to simplify the process. There's also been a continual and ongoing development of the format and look and feel of the trust tax returns, as well as the assessments that are issued to trust taxpayers. And the next part of improving the service offering, albeit that trustees may not feel it as an improvement to them, it's that SARS has been very clear to make it public that it will invoke all measures that are available to the Commissioner in the legislation if trusts or the beneficiaries do not comply with their obligations. So in layman's terms, what does that mean? It means that when you do the wrong thing, you are going to be at risk of SARS potentially imposing understatement penalties or the administrative non-compliance penalties. Taking another background look at how we've got to this point in time, I think it's important to understand how SARS has given effect to its whole modernization of the tax return process. And I mean, we're looking back as far as the last 10 years. So if we dive in back to 2014, this is where SARS commenced the process of trying to be more advanced in terms of the trust tax return format. And we would have seen the commencement of certain trust details being pre-populated. They would have started also calling on full details to be declared of the parties that were either contributing to or benefiting from the trust. We then progressed along to 2015, where they stepped up their level of obligation on the trustees, whereby certain fields that had now been introduced as new return disclosure fields being optional in the first year to create the introduction to people completing these returns. In 2015, a number of these fields now started becoming mandatory. So in order for you to complete your tax return and get to a position of being able to file it, you were being enforced to capture a lot more detail and data than perhaps what you may have been familiar with in the earlier years. Again, SARS started trying to bring some automation into the tax returns, albeit that at this point in time, relatively rudimentary, whereby certain fields were being automatically calculated to sum up totals, just as a form of control check process. Moving on a little bit further to 2017, and looking at the tax returns as they stood at that point in time, SARS started trying to get a little bit more clever in terms of the mechanism through which it collated and collected data. So if we looked at a field for something like a disclosure of your loan accounts that existed in the trust, they wanted to now see a split of what were interest-bearing loans versus interest-free loans. Now, in the current era, when we understand the complications of interest-free loans in the context of 7 Cap C, we can understand what SARS was perhaps trying to achieve by bringing in this new advancement all the way back then to build this data and start understanding what is the true nature of the underlying components of the trust affairs so that the appropriate tax laws could be appropriately applied to them. Back at that stage in 2017, where there was a further enhancement coming through in the tax return look and feel as far as the rental and the farming categories were concerned. So you can see that they're not sitting quiet. They were continuing to develop and develop piece by piece all the different sections of the tax return to be more consistent with other returns we were familiar with, perhaps at an individual level. Stepping on now to 2018, the tax returns took a next big jump. The disclosure of all details for parties that were transacting the trust were greatly enhanced. Now, this was also a point in time where SARS started introducing validation checks in the returns. So this is where they were bringing some logic where they would be able to block the filing of the return until a validation check had been completed, such as if you had identified that there was taxable interest income that was awarded to beneficiaries. Because you are now declared to disclose the full detail of this per beneficiary, it would sum up the control totals of what was being awarded. And if there was a breakdown in the reconciliation of the amount per person to the total value, it would block the filing of the return until that validation check could be cleared. This was also a point in time when the new 7 Cap C reporting for loans, advances or credits to a trust was brought about. So this was an important new element of disclosure where SARS was once again using the tax return as a mechanism to gather and collate data that would enable it to consider compliance with the legislation. The further advancements at that point in time was SARS broadening the administrative fields linked to tax returns for trusts, whereby they were identifying the specific different types of trust that may well exist. So there could be a more accurate disclosure of the nature of your organization. And perhaps quite importantly as well, identifying optional fields to be completed to identify the nature of beneficial rights that attach to parties, and that would be whether there was vested rights or discretionary rights that applied within the trust. It also brought about a point in time when there was an identification of minimum documents that should be submitted to SARS when called upon in a verification process. When we now stepped forward to 2019, this was a point in time when taxpayers would have identified quite a leap in terms of the look of the tax return. For those trustees or parties that would be looking at the returns, when they would have been familiar with looking at their own personal individual tax returns and the look and feel of those returns at that point in time, suddenly there would have been now a consistency coming through. This was when SARS moved from the Adobe-based format of the return to an HTML format to make it much more user-friendly on their reporting channels and creating a consistent look with the rest of corporate and individual tax returns. It was also a point in time when SARS was being open to understanding new trends in the market, new focus areas, and this was where cryptocurrencies were becoming a much bigger deal. And accordingly, they advanced the tax return to cater specifically for these cryptocurrency trades and the appropriate disclosure of the results from those activities. Stepping a little bit closer to our more recent times in 2023, there was some distinct drastic changes that came about as a result of South Africa's grey listing. We know that there's a distinct focus on now the new concept of beneficial ownership. And specific to our trust taxpayers, this fed its way through to the trust tax returns. And a new obligatory section of the tax return that had to be completed was the beneficial ownership details. And this, of course, caters for all categories of beneficial owners as they use the term in the trust context, covering donors, trustees, as well as beneficiaries. So please don't be off-put by the concept of the term that was used to identify this disclosure of beneficial ownership. It is a broader category of parties that it seeks to identify. So again, those people that were closer to the process of finalizing 2023 tax returns, this brought about an added complexity to these tax return filings, because as much as it is details that in certain instances are not too hard to gather, it was included fields that were not necessarily readily available. So this frustrated and delayed the process of the 2023 tax return filings. It increased cost and time costs incurred to complete these tax returns. Another big advancement that has now been brought about in trusts is a mandatory upload of supporting documents to enable the filing of the tax return. So this is a move away from the concept of calling on supporting documents to be uploaded, but rather to block the filing of the tax return until these mandatory documents are uploaded. And these documents that they're seeking are things such as your trust instruments, that being your deed of trust and letter of authority, then also needing your financial statements, as well as your trust resolutions passed and any minutes of meetings of the trustees held. That brings us all the way through to the present point in time. And in 2024 now, albeit not part of the trust tax return, but this brings us to the whole SARS modernization journey, where we now have the new IT3T third-party reporting that is kicked in. So what is this third-party reporting? If we take a pause and look to the Tax Administration Act, Section 26 of that Act is where the legislation is set, whereby the commissioner is entitled to obligate certain parties to submit these third-party returns. Now, those parties are not identified in the actual Administration Act, and a separate government gazette is issued whereby it is publicized who are the parties that are obliged to file the returns. Now, in the June 2023 government gazette that was issued, this is where the wording was extended to now include a trust as we know it. There were some very limited exclusions that were identified when trusts were added to this group, and that is limited to your collective investment schemes or an employment share incentive trust. So the reality is trusts are now required to file these third-party returns. You may now ask yourself, well, what is the purpose and the application of this IT3T reporting? So before we look at the purposes behind it, I think it's nice just to draw the comparison where you might be familiar with comparable type returns. And the most common example is your IT3B tax certificates that are issued by your banks. So as soon as an account holder is earning interest, the banks are obligated to do third-party reporting to report this interest earned. Now, this is the very comparable context whereby the IT3T is the certificate that the trusts are required to issue to their beneficiaries to identify amounts that have been awarded to them. So that brings us to our first point here. The purpose of this is that it's a forced reporting to SARS of any amounts that have been vested or awarded to a beneficiary, and that will include income amounts, taxable income. It could include taxable capital gains, as well as non-taxable capital amounts that could have been distributed to a beneficiary. What does this enable SARS to do? So as SARS collates and gathers this information, it should be quite obvious that what they can do is a simple reconciliation process to an individual beneficiary's tax return. If SARS was auditing or investigating a certain individual, and there was a desire to see whether this individual had amounts awarded to them in the capacity as a beneficiary of a trust, they would now be able to compare back to detail on their systems whereby the trust has submitted information of the amounts awarded. And if that individual so happens not to have disclosed those amounts in their personal tax return, it gives SARS the ability to raise an understatement penalty on that individual taxpayer. What I think the eventual goal of SARS will be is to enable a proper pre-population of that beneficiary's tax return. Now, this is what we have already seen with regards to IT3B tax certificates and bank interest, for argument's sake, whereby those values are pre-populated in the individual's tax return when it is created. And SARS's goal in getting that end treatment is that it will minimize the risk to SARS of an individual beneficiary not declaring this information and accordingly guaranteeing the ability to collect their taxes on taxable income of the respective parties. So that is definitely the goal of what they want to achieve out of this third-party reporting process. Now to take a chance to understand what is the data that is actually disclosed on this IT3T form. And it's a lot more than what you might feel is compared to the IT3B certificate that you receive from your banks. The actual reporting process is quite onerous at a trust level. And it will kick off with, firstly, the contact details of the person who's actually submitting the form. It'll then have to feed into the full contact and the identification details of the submitting entity. So at this point in time, we're gathering a whole lot of data that has to be completed and filled in on this form, and we are not even looking at a beneficiary as yet. We then need to step into capturing all of the details, which is the full contact, the identification, and the registration details of the actual reporting institution. So now this is, for argument's sake, the actual trust who is declaring these details. So there's a whole batch of data that has to be completed and populated on these returns, again, before we are even getting to a beneficiary. Only now are we at a position to identify the full contact, identification numbers, and registration details of the actual beneficiary. What's important to note at this point here is that when we identify this beneficiary, it is not just by name and not even just by ID number. It will also require the tax registration number of that beneficiary to be captured. So once again, you can imagine this is going to simplify SARS's process of being able to try and reconcile these details to the underlying taxpayer. So again, a wealth of information being captured here before we even get into any amounts. Eventually now, we will get to the details of the amounts to be captured of amounts that were vested in the underlying beneficiary. And that will extend to as well contributions made to or received from the trust. as well as any capital amounts or assets that may have been awarded to the beneficiary. So a distinct wealth of information that has to be captured in this return. Now that we understand the volume of data that actually has to be captured, that all sounds technically simple, but bearing in mind a lot of complexity in going through the steps to complete it. You then need to use the appropriate channel to ultimately file this return to SARS. And SARS has provided 3 channels through which the filing can be made. The first and perhaps easiest channel to follow is directly via SARS e-filing. There is, however, a limitation to that approach, whereby the IT3T return will only cater for a maximum of 20 certificates to be captured. So if you happen to be in a position whereby your trust has a greater volume of beneficiaries where you need to declare these details, that channel may no longer be appropriate. However, for the majority of trusts, I would anticipate that this would be the logical channel to be followed. The way that the actual return works is it's almost then in 2 components. There's an actual data return, which comprises the detailed information and amounts per beneficiary. And then there is a separate form, which is the actual summary return. So this is similar to the concept that's applied on dividends tax filings, whereby there's almost a data file and then a summary return. So the 2 components comprise the overall filing that happens. The next channel available to taxpayers is the HTTPS reporting channel. Now, this is a mechanism whereby your data is reduced to almost a simple text-based format. So it enables a higher bulk of data to be submitted in a relatively small sized file. The challenge with this process, though, is that in order to follow this submission approach, there's a very strict setup process that has to be followed in e-filing by a practitioner to be able to even consider being able to file through this channel. So parties need to be registered to fulfill certain roles in this reporting approach. There's a security certificate that needs to be obtained. So this is important to understand, that you don't come along on D-Day and think you can use this channel to submit. There's a distinct preparation process to be followed to at least be set up if this is even going to be considered as an option. The final channel of data submission is then via Connect Direct. Now, this is actually a paid platform that parties can use to submit data. This is not held to really be appropriate for trusts in the majority of our circumstances. This is a platform that would normally be utilized by parties such as banks or financial institutions, where their volume of data is next level. So that is probably not really applicable to the trusts that we would deal with in the normal context. What is our due date for submission? So the first year of reporting that this applies to, it will relate to the tax year that ended on the last day of February 2024. The returns for that tax year, these IT3T returns, have to then be filed by the end of September 2024. So a date that is not far away. We need to bear in mind here that the initial deadline that was set for submission of these certificates was the end of May, which so happens to be the same date when your financial institutions would be uploading their IT3B certificates. There was a huge outcry against this by the profession, basically identifying that that would have been fundamentally impossible. SARS eventually seemed to understand and appreciate the concerns that were being raised by practitioners and the professional stakeholders. And as a result, that's why they settled on this 30 September deadline. And it's important just to understand that this deadline date is totally different to the actual deadline date for the filing of the income tax return. So your filing of your income tax return for the trust will, dependent on whether or not you're a provisional taxpayer, fall in either October 2024 or later in January 2025. So distinctly different dates that apply to these different returns that have to be filed by the trusts. Then the big question, what happens if this filing is not made on time? Now, technically, SARS does have the ability to invoke its administrative non-compliance penalties if returns are not filed timeously. But our understanding is that with this first year of filing on these returns, we do not believe that penalties will be invoked if taxpayers are late. But again, that should not be seen as any reason to step off the pedal and not to push ahead in trying to be compliant, because this is with us going forward, and we will need to be understanding how we set up our systems to be able to comply with these timeframes. I think now just what I want to touch on is, now that we kind of have a feeling of what has to be done, how do we actually need to prepare to be ready to do this? And this is perhaps almost the most critical element. The first thing is that you need the data to be able to be declared. So your financial results need to be finalized for this tax year. Your financial statements need to be prepared. Your tax computation needs to be finalized. So all of those steps take time. We often struggle with certain trust clients for convincing them to gather and supply the relevant detail. We then you need to understand, dedicate our resources to go through the motions of processing your accounting records so that you actually have proper data backing up your financial statements and preparing these end results. Once you have that position up in hand and you have your financial statements, you now have a process to follow on SARS e-filing. So these new certificates, they're actually filed through a new tax type. So there's an IT3 tax type that correlates to this reporting. And this means that the tax type actually has to be activated for each taxpayer in e-filing. Now, that is not necessarily just a simple tick box approach. So it starts with a tick box to activate the tax type, but then it is not activated until such time as your trust representative trustee actually approves the activation of the tax type. So it does require that representative to log into a prescribed link that will be sent to them and approve this activation. The bigger problem that we're finding, and especially so with older trusts that have been set up many years back and have been consistently running along and doing the right thing, the problem is that because these trusts are older, from a time when SARS systems were not as advanced as they are now, as SARS has modernized its internal systems and info gathering processes, for a new trust that has been registered fairly recently, all of these prescribed fields related to a trust would have been captured, verified, and updated. However, for a lot of your older trusts, what we're finding is that SARS has never actually recorded and reflected details of who is, for argument's sake, the representative trustee. So what we have already initiated is a process now whereby we are trying to update all of these details such that the representative trustees can actually be recorded on the SARS system, which is absolutely necessary that when you get to the position of activating the tax type, someone is recorded on SARS system to actually approve it. And I think this is where I just want a little bit of understanding from perhaps our trust clients and all the relevant stakeholders involved to appreciate all of the complexities to get to this end position. These processes are complex. They take time. There's a number of strict procedures you need to follow to arrive at the correct end results. So we need to work together with you. We need your cooperation. We need your commitment to understand you are not just there as a passenger waiting for an end result. You need to be party to this whole process. And I think, that's the awareness that we want to create out of this process, out of this webinar, to give you this general understanding. And hopefully, this is giving you a good insight so that you can be better prepared to hopefully be compliant for this upcoming reporting process. If you do have any questions, you are most welcome to send those through via email. We will take a look at those to see how we can assist and revert back to you to address any questions that you may have. But thank you again for your time. Thank you for dialing in. Please watch out for any future webinars coming your way, and have a good day further. Thank you very much.